Welcome back. If you listened to episode 1, you already understand the foundation. You know why markets don't reflect reality. You know why prices are always distorted. And you know the mechanism of reflexivity, the two-way loop between perception and reality, the force that makes bubbles not only form, but last longer than anyone predicts. But here's what episode 1 didn't answer. Why do bubbles grow so large? Why does no one stop them? And why, every time they burst, does the world insist it couldn't see it coming? Episode 2 is where we dive into those questions. In this episode, we'll move through 6 parts. We begin with what lies behind every market swing: negative feedback and positive feedback. 2 opposing forces that determine where the market is headed and how fast. From there, we'll look at the structure of a financial bubble, not as a random accident, but as a machine with its own architecture and rules of operation. Then we'll walk through each stage of a bubble's development, from the moment the seed is planted, to the peak no one wants to admit is the peak, to the collapse everyone claims was a surprise. And to make the theory real, we'll examine the most vivid example in modern history, the real estate bubble, a case where reflexivity didn't just appear, it operated with frightening perfection. From there, we'll step into 2008. Not to retell history, but to understand why Soros called it a super bubble, and why the belief that markets self-correct was not only wrong, but the direct cause of disaster. Finally, we'll end with the question Soros considered most important: who is responsible, and how must the financial system change to prevent history from repeating itself? If episode 1 showed you how markets operate, episode 2 will show you what happens when no one can control them. Let's begin. Part 5. Negative and positive feedback. The hidden forces behind market fluctuations. After explaining reflexivity, the two-way relationship between perception and reality, George Soros continues by analyzing the types of feedback loops that exist within financial markets. These are the invisible forces that determine whether the market is stable or extreme. First, he divides feedback loops into 2 basic types: negative feedback and positive feedback. This distinction is crucial because it explains why at some times the market operates stably, while at other times it becomes extreme. Negative feedback is the familiar type of feedback in natural and economic systems. It always intervenes to adjust and bring the system back to equilibrium. When the system deviates from its normal state, negative feedback corrects it. The simplest example of negative feedback is the law of supply and demand. When the price of a product rises too high, demand falls because buyers do not want to pay the high price. Producers increase supply to take advantage of profits. As a result, the price begins to fall. When the price is too low, demand rises and supply falls, and the price begins to rise again. In this case, the market self-adjusts through negative feedback. This is also the mechanism that the efficient market hypothesis relies on when it claims that markets are always stable. However, Soros argues that negative feedback is only part of the story. In reality, financial markets are always influenced by another feedback loop, much stronger and more dangerous: positive feedback. Positive feedback is the opposite process. Instead of restoring equilibrium, it amplifies distortions. When a trend begins, positive feedback creates forces that make the trend stronger, faster, and more widespread. For example, when the price of an asset begins to rise, it attracts buyers' attention. They see the price rising, believe the upward trend will continue, and buy in. Buying creates more upward momentum and a self-reinforcing loop. Price rises, confidence rises, buying increases, and price rises further. A recent example is the stock market rally. At first, the market may rise due to fundamentals, such as economic growth or corporate profits. However, rising prices then become the main driver pulling the market higher. More and more people start buying because of the trend rather than value. This pushes prices above real value. The clearest example is the dot-com bubble. Initially, the internet was a promising technology, that was the reality. But as stock prices rose sharply, many people began to believe that any company related to the internet would succeed and bought in. Money poured into the market, driving stock prices higher, creating belief, creating new forces for prices to rise further, and the positive feedback loop was formed. Eventually, stock prices rose far beyond real value. Between 2017 and 2018, the cryptocurrency market also created a positive feedback loop. Many people bought cryptocurrencies not because they understood blockchain technology, but because prices were rising. More buyers created upward pressure on prices. Rising prices created belief that the market was rising. The more people joined, the stronger the upward force became. This was a classic self-reinforcing loop. However, Soros warns that positive feedback cannot last forever. Although this reinforcing force can persist, after a certain time the market reaches a level where reality can no longer support expectations. At that point, the reinforcing process begins to weaken. Some people start to doubt and prices stop rising or show signs of falling. When the upward trend disappears, confidence declines. If confidence declines, buying decreases and prices begin to fall. Falling prices create the opposite negative feedback loop. Prices fall, confidence falls, selling increases, and prices fall further. This is why declines always happen much faster than growth. The shift from greed to fear leads to extreme investor reactions. Soros asserts that positive feedback is the key factor to understand when talking about major market fluctuations. While negative feedback helps stabilize, positive feedback causes strong movements, both upward and downward. The special point is that positive feedback often creates the illusion that the market is correct. When prices keep rising, everyone thinks the market is accurately reflecting reality. But in fact, it is not. In reality, the market never purely reflects reality. It always creates forces that amplify belief. In other words, the market may be right about the outcome but wrong about the cause. The clearest example is when a company is truly growing strongly, rising stock prices are reasonable. But when the process becomes extreme, prices rise far above real value. At that point, the market is still right about the trend, but no longer reflects true value. At the same time, Soros says, we do not always know whether negative or positive feedback is dominant. This uncertainty is why markets are so hard to predict. At times, the market operates stably with small random fluctuations. Negative feedback plays the main role. But in other periods, trends become strong and prolonged. Positive feedback dominates. The transition between these states creates market cycles. Thus, in this part, Soros affirms that the market does not only have balancing forces, but also amplifying forces. While balancing forces help maintain stability, amplifying forces create strong trends, major fluctuations, and bubbles. Understanding these two mechanisms helps us see the market more realistically. The market is not always rational and stable. It can push itself too far, both upward and downward. And it is precisely in the strongest positive feedback phases that the greatest opportunities and the greatest risks appear simultaneously. In other words, the market is not a static system that can be analyzed once and for all. It is a dynamic system, always changing, and the very attempt to predict it can feed back into the outcome. In summary, Soros offers a different perspective on financial markets. The market does not simply reflect reality. It is a reflexive system where perception and reality continuously interact. This mechanism explains why distortions can persist, why bubbles form, and why crises appear. Part 6. The architecture of a financial bubble. After breaking down the mechanics of positive and negative feedback, the forces running underneath every market, George Soros turns his attention to one of the most important phenomena in all of finance, the bubble. To Soros, bubbles aren't random events, they aren't rare accidents. They are the natural outcome of reflexivity when positive feedback takes over and runs unchecked. What makes Soros's perspective different is that he doesn't look at a bubble and simply say, prices got inflated. Instead, he argues that every bubble has a clear structure, built from two core components: a real trend that exists in reality and a misconception about that trend. These two elements interact through positive feedback, creating a self-reinforcing process. That process is the bubble. The first thing to understand is that bubbles don't start from nothing. They always have a foundation in reality. This is a point Soros emphasizes strongly because it explains why bubbles can last so long and why they manage to convince so many people along the way. Take the dot-com bubble of the late 1990s. It wasn't pure fantasy. The internet was genuinely a revolutionary technology, and it did change the world. That's the real trend, the first component of the bubble. But alongside that real trend, a misconception took hold. The belief that any company with a connection to the internet would succeed and would eventually be worth an enormous amount of money. Investors started pouring money into companies by the hundreds, including companies with no clear business model and no path to profitability. That's how a bubble forms. A real trend gets amplified by a false belief. Soros calls this a boom-bust process, a cycle of aggressive growth followed by collapse. The process kicks off when the real trend and the misconception start reinforcing each other. When the real trend produces positive results, it strengthens investor conviction. When conviction rises, people invest more, pushing prices higher. Higher prices make the trend look even more justified, and the positive feedback loop keeps spinning. In the real estate bubble, the real trend was straightforward. Low interest rates and easy access to credit allowed more people to buy homes than ever before. That drove prices up. And as prices rose, more people came to believe that real estate was a safe investment that would always generate returns. That was the misconception. That belief pushed even more people into the market, not just to buy homes to live in, but to buy homes as investments, which pushed prices higher still, which reinforced the belief that the market was moving in the right direction. The loop continued. But Soros is careful to point out that this process doesn't run smoothly from start to finish. Throughout the formation of a bubble, there are tests, periods where the trend gets challenged. Prices might dip slightly on bad news, or because some investors take profits. If the underlying trend is strong enough, the market recovers and keeps climbing, and each recovery makes the belief in the trend even stronger. But here's the thing. That's exactly what makes the system more fragile. Every time the bubble survives a test, conviction deepens, and the gap between price and reality grows wider. Gradually, the bubble enters what Soros calls the twilight period. This is when doubt starts creeping in. Some investors begin to sense that prices have moved too far from reality. They get nervous. They start selling. But the overall trend hasn't broken yet. Driven by inertia, the market keeps moving in the same direction. Prices may still rise or hold at elevated levels, even as confidence quietly starts to crack. One of the most famous examples Soros points to is a quote from Chuck Prince, the former CEO of Citigroup, who said, "As long as the music is playing, you've got to get up and dance." That line perfectly captures the psychology of the twilight period. Everyone knows something is off, but nobody wants to stop, because stopping means missing out. Eventually, the bubble reaches a reversal point, a peak. This is the moment when reality can no longer support expectations. Maybe earnings disappoint. Maybe a single event shifts the mood of the market. Whatever the trigger, the positive feedback loop begins to run in reverse. Prices fall, confidence falls with them. Selling accelerates, and the collapse tends to be fast and steep because it's being driven by the same mechanism that pushed prices up in the first place, only now it's working in the opposite direction. Soros also notes that not every bubble makes it to a complete collapse. In some cases, negative feedback steps in and interrupts the process, a government intervention, or some external force that breaks the cycle early. If a central bank raises interest rates or tightens credit, for example, it can slow the market's momentum and prevent the bubble from growing to dangerous levels. But if the intervention is too weak or mistimed, the bubble keeps building. Another key observation Soros makes is that bubbles tend to be asymmetric in shape. The rise is usually long and gradual, the fall is usually short and brutal. This happens because belief builds slowly on the way up. But when belief collapses, the market's reaction is immediate and violent, driven by panic and forced liquidation of positions. The 2008 financial crisis is the clearest example. The American real estate market climbed for years. When it finally broke, it broke fast, and it took banks and financial institutions down with it. In the end, Soros's view is this: bubbles are not abnormal events. They are not exceptions to the rules of markets. They are the logical result of how markets actually operate. Every bubble has a real foundation, but that foundation gets distorted by a false belief. The two feed each other through positive feedback, and the self-reinforcing cycle does the rest. Understanding this architecture changes how you see markets. Instead of thinking bubbles are impossible to predict or easy to spot in real time, you start to understand that they are a natural part of the system, and they almost always only become obvious when it's already too late. This is also why Soros argues that managing markets cannot be based on the assumption that they are always rational. The opposite has to be accepted, that distorted thinking and flawed perception are unavoidable features of the system, and they are precisely what creates the largest movements of all. Part 7. The Stages of a Financial Bubble. After laying out the architecture of a financial bubble, built from a real trend and a misconception, George Soros goes a level deeper, walking through the specific stages that a bubble typically moves through. According to him, while you can't predict the exact timing or scale of each stage, the sequence itself follows a fairly clear internal logic. Understanding these stages doesn't just help us make sense of the past. It gives us a way to recognize, at least in part, what's actually happening in a market while it's happening. Soros breaks the life cycle of a bubble into several distinct stages, starting with inception and ending with bust. Between those 2 points is a progression of steps, each with its own psychology and its own pattern of market behavior. The first stage is inception. This is when a new trend begins to take shape in reality. It usually starts with something real, a new technology, a new policy, a shift in economic conditions. The rise of the internet in the 1990s, or the emergence of artificial intelligence in recent years, are both examples of real trends. In this early stage, only a small number of people recognize the potential. Prices of related assets may start to move, but there's no widespread attention yet. Then comes the acceleration phase. As the trend begins to prove its value, more people start to participate. Prices rise faster and market attention grows. This is where positive feedback becomes visibly active. Prices rise, which attracts investors. Investors buy in, which pushes prices higher. Prices rising further makes the trend look even more valid. The loop keeps going. The key thing to note here is that during this stage, the trend is still grounded in a reasonably solid foundation of reality. From there, the bubble moves into what Soros calls the testing phase. These are the moments when the trend gets challenged. Bad news surfaces. Prices go through a correction. In a rising market, prices might pull back 10 to 20% over a short period. These pullbacks cause some investors to question whether the trend has run its course. But if the underlying trend is strong enough, the market recovers. And that recovery does something important. It deepens investor conviction. People start to believe that any dip is temporary and that the market will always find its way back up. This creates a critical dynamic. Every time the bubble survives a test, market confidence increases, and so does the gap between price and reality. After that comes the twilight period, one of the most subtle and difficult stages to identify while you're inside it. This is when the first signs of instability start to emerge. Some experienced investors begin to sense that prices have moved well beyond fair value. They may start reducing their positions or selling outright. Negative headlines start appearing more frequently, but the main trend hasn't broken yet. What makes this stage particularly interesting is the contradiction sitting at the center of market psychology. On one hand, the warning signs are there. On the other hand, the momentum of the trend keeps the market moving in the same direction. Many people know the market is probably running too hot, but they keep participating anyway because they're afraid of missing out. This is one of the most common psychological patterns in the late stages of any bubble. The famous line, "As long as the music is playing, you've got to get up and dance," captures this state perfectly. Investors are aware of the risk. They keep dancing anyway. Eventually, the bubble reaches its reversal point, the peak. This is the moment when the trend can no longer sustain itself. It might be triggered by a specific event, a major company reporting losses, a policy change, a financial institution collapsing, or it might simply be that market conviction has finally reached its limit. When the reversal hits, positive feedback starts running in reverse. Prices fall, which erodes confidence, which triggers more selling, which drives prices down further. This process almost always moves faster than the rise did. What follows the reversal is the bust. This is when everything that was hidden during the run-up gets exposed. Low-quality investments, risky loans, unsustainable business models, all of it comes to the surface at once. Markets tend to fall into panic during this phase. Investors try to sell at any price they can get. Liquidity dries up. Prices can drop dramatically in a very short period of time. One of the key observations Soros makes here is that bubbles are asymmetric in shape. The rise is long and gradual. The fall is short and steep. A market might take years to climb from its lows to its peak, but only months, or even weeks, to collapse. This happens because the downside isn't just driven by psychology. There are technical forces at work too: forced selling, margin calls, asset liquidations that compound the move. The 2008 financial crisis is the clearest example. The American real estate market climbed for years. When it finally broke, it brought down major financial institutions in a matter of months. Soros is also careful to note that while the sequence of stages can be anticipated, the timing and magnitude of each one cannot. A bubble can last far longer than most people expect, which is part of what makes it so dangerous. The process can also be interrupted by outside forces, particularly government intervention or central bank action. Cutting interest rates or injecting liquidity into the system can extend the expansion phase or slow the pace of collapse. But these interventions typically delay the outcome rather than prevent it entirely. What Soros provides in this section is essentially a map, a framework for understanding how a bubble develops over time, from inception to acceleration, to testing, to the twilight period, to reversal, to bust. Each stage has its own internal logic, and each reflects the ongoing interaction between perception and reality. Understanding these stages doesn't mean you can time the market with precision, but it does give you a clearer sense of where you might be standing inside the cycle. More importantly, it helps you understand that what you're watching in the market isn't random. It's the result of deep structural mechanisms that were already in motion long before most people noticed. Part 8. The Real Estate Bubble, a classic example of reflexivity. After presenting the structure and stages of a financial bubble, George Soros turned to a specific and easy-to-understand example to illustrate his entire theory: the real estate bubble. According to him, this is a simple case, but the clearest demonstration of how reflexivity operates in practice. The starting point of a real estate bubble is usually something very ordinary and seemingly reasonable. Credit becomes cheaper and more accessible. This can happen when the central bank lowers interest rates or when the banking system expands lending to stimulate economic growth. When interest rates are low, borrowing becomes more attractive. More people can borrow to buy houses, including those who previously could not afford it. Demand for housing rises, and this pushes real estate prices higher. Up to this point, everything still seems perfectly logical. Prices rise because demand rises, and demand rises because financial conditions are more favorable. But it is precisely here that a distorted perception begins to form. That false perception is the value of collateral real estate is independent of credit conditions. In other words, many people start to believe that housing prices rise because of their intrinsic value, not because credit is being expanded. They assume real estate is always a safe asset and its price will continue to rise over time. This is exactly where reflexivity begins to take effect. As real estate prices rise, the value of borrowers' collateral also rises. This makes banks feel safer about lending, because if borrowers default, the banks can still recover high-value assets. The result is that banks begin to loosen lending standards. They are willing to lend more, even to customers who are riskier than before. For example, in the period leading up to the 2008 crisis in the US, many banks offered home loans under very easy conditions, sometimes without properly checking borrowers' income. These loans were called subprime, meaning they were given to people with low repayment ability. As credit expanded, more and more people could enter the housing market. Demand surged and prices kept rising. Rising prices made collateral appear safer, encouraging banks to keep lending. This is a classic positive feedback loop. Credit expands, asset prices rise, collateral value rises, banks lend more, credit expands further. During this phase, everything seems to be going well. Home buyers see their assets appreciating, banks profit from lending, and the economy as a whole grows. One important factor Soros emphasized is that default rates usually decline during this phase. This further reinforces the belief that the system is stable. For example, when housing prices rise, if someone cannot repay their loan, they can still sell their house at a higher price to cover the debt. This makes loans appear less risky than they actually are. When default rates are low, banks grow even more confident and continue to loosen lending standards. This is a clear example of how good short-term indicators can mask long-term risks. However, Soros pointed out that it is precisely at the peak of the bubble that the system becomes most fragile. When credit reaches its maximum and asset prices are pushed too high, even a small change can trigger a reversal. The reversal can start from many causes: rising interest rates, declining household income, or simply a saturated market. When prices stop rising, confidence begins to falter. As real estate prices start to fall, the entire reflexive mechanism reverses. Prices fall, collateral value falls, banks grow cautious, lending tightens, fewer people can buy homes, demand falls, prices fall further. This is a positive feedback loop in the negative direction. One factor that makes the collapse more severe is forced liquidation. When borrowers cannot repay, banks are forced to seize and sell collateral. This increases supply in the market, driving prices down even further. In the 2008 crisis, this happened on a massive scale. Millions of homes were foreclosed and sold, causing real estate prices to plummet. Soros also emphasized that distorted perceptions about real estate are not new. They have appeared in various forms throughout financial history. For example, in the international banking crisis of 1982, the issue was not real estate, but sovereign debt. In that case, there was no specific collateral, but banks still assessed countries' repayment ability based on indicators like debt to GDP ratios. These indicators were considered objective, but in reality they were also reflexive. When capital flowed into a country, its economy grew, making financial indicators look better. This attracted more capital, creating a loop similar to real estate. A specific example was Brazil in the 1970s. When petrodollars, oil revenues, were reinvested in developing countries, large capital inflows went into Brazil. This improved its debt indicators, prompting banks to lend even more. But when capital flows reversed, the system quickly collapsed. In summary, through the real estate example, Soros wanted to show that reflexivity is not an abstract concept, but a very real and observable phenomenon. The real estate bubble clearly demonstrates how a real trend, cheap credit, combined with a false perception, asset prices independent of credit, can create a powerful positive feedback loop. This process affects not only prices, but also changes the behavior of banks, borrowers, and the entire financial system. And when it reverses, the consequences extend beyond real estate, potentially spreading throughout the economy. This is why Soros argued that we cannot understand markets only through static models. We need to look at dynamic processes, where perceptions and reality continuously interact with each other. Part 9. The super bubble of 2008 and the false belief in self-correcting markets. After explaining ordinary bubbles and how they operate, George Soros advanced a more important argument. The financial crisis of 2008 was not simply the result of a single bubble, but the collapse of a super bubble that had been building for decades. According to him, the US housing bubble, especially the subprime bubble, was merely the final trigger. When it burst in 2007, it set off the implosion of a much larger structure, like a conventional bomb igniting a nuclear explosion. To understand this, one must look beyond housing and examine the long-term trends that had unfolded in the global financial system. Soros argued that this super bubble was built on two core elements: a real trend, the increasing use of credit and leverage in finance, and a false perception, the belief that financial markets are inherently self-correcting and should be left to operate freely without intervention. The first trend, the rise of credit and leverage, is easy to observe. For decades leading up to 2008, banks, investment funds, and financial institutions relied more and more on debt to amplify returns. A bank, for example, would not only invest its own capital, but also borrow additional funds to invest even more. This magnified profits when markets were favorable, but it also magnified risks when markets turned. Alongside this came the growth of complex financial instruments such as securitization, collateralized debt obligations, CDOs, and other derivatives. These tools allowed institutions to package loans and sell them, freeing up capital to lend again. The result was a financial system that expanded rapidly and became tightly interconnected. What made the super bubble dangerous was not just the expansion of credit, but the belief that accompanied it. This belief, what Soros called market fundamentalism, held that markets are always efficient, always self-correcting, and therefore should be left alone by governments. This view gained traction in the 1980s, especially under President Ronald Reagan in the US and Prime Minister Margaret Thatcher in the UK. They believed deregulation and free markets would maximize economic efficiency. Soros did not deny that markets can be efficient in many cases, but he argued that the conviction that markets are always right and always self-correcting was a grave mistake. Ironically, this belief was reinforced by a series of earlier crises. Over the years, the financial system faced repeated shocks: the international banking crisis of 1982, Black Monday in 1987, the savings and loan crisis, the emerging markets crisis of 1997-1998, and the dot-com bubble in 2000. Each time, regulators intervened to save the system by cutting interest rates, injecting liquidity, or directly rescuing major institutions. These measures prevented immediate collapse. Yet, according to Soros, they also created a dangerous reflexive effect. Every time the market was saved, investors grew more confident that the system was safe. They believed that if trouble arose, governments and central banks would step in. This belief encouraged them to take on greater risks. Financial institutions used more leverage, convinced they would not bear the full consequences if things went wrong. This created a systemic positive feedback loop. Crisis, intervention, confidence rises, risk rises, bigger crisis. Each prior crisis was like a test of the system, and because the system survived, faith in it grew stronger. But this faith only inflated the super bubble further. Eventually, the expansion of credit and leverage became unsustainable. When the US housing bubble began to burst in 2007, it triggered a chain reaction. What made the 2008 crisis uniquely severe was the degree of interconnectedness in the financial system. Banks and institutions were not isolated in one market. They were linked through complex financial products. When one part of the system collapsed, the damage spread quickly to others. Soros emphasized that deregulation had dismantled the firewalls that once separated different financial activities, which had previously limited contagion. With those barriers gone, risks spread rapidly. The result was that when the subprime bubble burst, not only housing but the entire global financial system fell into crisis. The climax came with the bankruptcy of Lehman Brothers in September 2008, a shock that nearly paralyzed financial markets. Governments were then forced to intervene with unprecedented measures to keep the system alive: massive liquidity injections, bailouts, and artificial support. In summary, Soros extended the bubble theory from the level of individual markets to the level of the entire system. He argued that the 2008 crisis was the result of a super bubble built over many years, fueled by the combination of rising credit and leverage and the false belief in self-correcting markets. His central point was that markets do not always fix their own mistakes. On the contrary, left unchecked, they can amplify errors to the point of causing catastrophic consequences. Understanding this is the first step toward building a more stable financial system in the future. Part 10. Solutions. The role of regulators in reforming the financial system. After analyzing reflexivity, the structure of bubbles, and especially the formation of the super bubble that led to the 2008 crisis, George Soros turned to the most important question: what must we do to avoid repeating those mistakes? He argued that if we continue to believe markets always self-correct and can fix their own errors, similar crises will inevitably recur. Therefore, we must change our perspective and rebuild the financial system on a more realistic foundation. Soros's starting point was clear: financial markets are inherently unstable and prone to creating bubbles. This is not an exception, but a systemic feature. As a result, he believed financial regulators must accept responsibility for preventing bubbles from growing too large. Yet this is not simple. One common argument against intervention is that if markets themselves cannot recognize bubbles, then regulators cannot be expected to do better. Alan Greenspan, former chairman of the Federal Reserve, once said that if markets cannot detect bubbles, there is no reason to believe regulators can. Soros acknowledged that this argument has some truth. Regulators are human, with limited perception and prone to mistakes. But he emphasized that this does not mean they should stand aside. On the contrary, they must act, even knowing they may not be perfect. The difference, Soros explained, is that regulators have one advantage markets do not: the ability to receive feedback from the entire system. They can observe signals, assess the impact of policies, and adjust when necessary. In other words, market regulation itself is a reflexive process: action, market reaction, policy adjustment. One of Soros's key proposals was that regulators must control not only the money supply, but also credit. In traditional economic models, central banks primarily adjust interest rates and money supply to influence the economy. Soros argued this is insufficient, because financial bubbles are not only about money, but also about how credit is used. For example, if interest rates are low, but banks maintain strict lending standards, a bubble may not form. But if lending standards are loosened, credit can expand dramatically and create a bubble even when rates are not especially low. Therefore, Soros proposed that regulators employ tools such as margin requirements and minimum capital ratios. Importantly, these tools should not be fixed, but adjusted flexibly according to market sentiment. When markets are overly euphoric, requirements should be tightened to limit leverage. Conversely, when markets are weak, they can be loosened to support recovery. He also suggested reviving or developing regulatory tools that existed in the past. For instance, central banks once required commercial banks to restrict lending in overheated sectors like real estate or consumer credit. Today, such measures are often dismissed as excessive interference, but Soros argued they are effective in preventing bubbles early. He pointed to China as an example, noting that during its growth phase, The government repeatedly raised reserve requirements to keep banks under tighter control. Another crucial element in Soros's argument was systemic risk. While individual investors may focus only on their own interests, the financial system as a whole can face risks no single participant can control. For example, an investor may believe they can always sell their assets if necessary. But if too many investors think the same way and all try to sell at once, the market cannot absorb it, leading to collapse. Regulators must therefore monitor aggregate positions across the system, not just individual actors. This includes oversight of large institutions such as hedge funds, sovereign wealth funds, and major banks. Soros highlighted the dangers of certain derivatives, particularly credit default swaps, CDS. These instruments can create hidden risks, difficult to observe, yet capable of accumulating within the system. He argued they must be strictly regulated and in some cases restricted or banned if they pose excessive danger. Another major issue is too big to fail. Institutions so large that their collapse would destabilize the entire system. Soros noted that once governments rescue such institutions, they effectively create an implicit guarantee. Knowing they may be saved, these firms take on greater risks. Thus, it is not enough to bail them out during crises. Stricter regulations must be imposed to limit their risk-taking. Examples include reducing leverage, restricting how they invest customer deposits, and separating high-risk activities from traditional banking. He also called for restoring firewalls between different parts of the financial system to prevent contagion. Finally, Soros stressed the importance of timing in reform. Immediately after a crisis, the financial system is fragile. Imposing overly strict regulations too quickly could slow recovery. Therefore, he advocated a two-phase strategy. In the short term, support the system with liquidity and stabilization. In the long term, gradually implement reforms to control risk. He used a vivid analogy. When a car skids, you must first turn the wheel in the direction of the skid before correcting course. If you do the opposite, you may lose control entirely. In conclusion, Soros emphasized that financial markets cannot operate perfectly on their own. They require oversight and adjustment. Regulation is not a flawless solution. It is a continuous process that demands flexibility, learning, and adaptation. Most importantly, we must abandon the belief that markets are always right, and instead accept that mistakes are an unavoidable part of the system. Only by acknowledging this can we build a financial system that is more stable and sustainable for the future. After laying out his arguments on reflexivity, bubbles, financial crises, and the role of regulators, George Soros closed his lecture with a deeply philosophical conclusion. The way we currently understand financial markets is incomplete, even distorted, and must be replaced with a more realistic approach. He began by comparing his own theory, reflexivity, with the efficient market hypothesis, which has long been the foundation of modern financial economics. According to the efficient market hypothesis, prices always fully reflect information, and any deviations are temporary and random. In that world, markets resemble an almost perfect system, where individual decisions, though independent, combine to produce rational outcomes. But Soros argued that this view does not reflect reality. Markets do not merely reflect information, they also create and distort it. Human perceptions are not always accurate, and those very misperceptions can shape reality itself. At the same time, he acknowledged something important. Neither reflexivity nor the efficient market hypothesis can be completely disproven in the strict scientific sense. This stems from a deeper issue. Financial markets are not physical systems that can be tested through repeatable experiments. They are social systems, where humans are both observers and participants. As such, there is no absolute truth that applies in all circumstances. Soros offered a candid personal example. He once predicted that the super bubble would burst in 1998, but he was wrong. Yet that did not mean his theory was invalid. It only showed that timing and market dynamics are extremely difficult to predict. Conversely, many supporters of the efficient market hypothesis continued to defend their view even when reality, especially the 2008 crisis, seemed to prove otherwise. This revealed an important fact. Theoretical models are not just scientific tools but also beliefs. And once a belief is formed, it is not easily changed, even in the face of contradictory evidence. Nevertheless, Soros observed that after the crisis, more and more people felt we needed a new paradigm to understand markets. He believed reflexivity could serve as a foundation for this new paradigm because it better reflects the true nature of markets, imperfect, unstable, and always influenced by human factors. He also compared his theory with another rising school of thought, behavioral economics. Behavioral economics focuses on studying human cognitive biases, emotions, and non-rational decisions. While Soros valued this approach, he argued it only solved half the problem. It explained why people misperceive reality, but not how those misperceptions can actually change reality itself. Reflexivity, by contrast, addressed that missing piece, the interaction between perception and action, and how together they shape outcomes. Still, Soros was frank in admitting his theory was incomplete. He described it as primitive and in need of further development, especially in studying the specific pathways through which price distortions affect economic fundamentals. He acknowledged that he alone could not fully develop the theory. It was a large task requiring the participation of many researchers and institutions. This was why he decided to establish and fund a new organization, the Institute for New Economic Thinking, INET. Its mission was to promote research, organize conferences, and build educational programs to develop new approaches in economics, beyond the boundaries of traditional models. Soros pledged $50 million over 10 years and hoped others would join. Importantly, he did not want to impose his own theory on the institute. Instead, he emphasized the need for diversity of thought, with reflexivity being only one of many research directions. He even proposed creating a Chinese wall between funding and research content to ensure objectivity. In the end, Soros's message was clear. Today's global financial system has been built on an incomplete theoretical foundation and must be rebuilt from the ground up. This is not an easy task. It requires change not only in policy, but also in how we think about markets, risk, and the role of human behavior in the economy. A simple example illustrates this point. If we believe markets are always right, we will pay little attention to risk and fail to prepare for crises. But if we understand that markets can be wrong, and wrong in systematic ways, we will be more cautious and build mechanisms to mitigate risk. In short, Soros's conclusion was not just a summary of his lecture, but a call to change our way of thinking. He did not offer a perfect formula for predicting or controlling markets. Instead, he emphasized the necessity of accepting uncertainty, recognizing our limits, and continuously adjusting our approach based on reality. This is the essence of reflexivity and the most important lesson he wanted to convey.